Indian retail success used to rely on a predictable formula. Companies secured prime real estate, built sprawling supermarket aisles, and relied on heavy foot traffic to drive sales. Zepto bypassed the traditional storefront entirely. Instead, it built a hidden network of over 1,000 dark stores, operating completely out of sight within dense residential neighborhoods. This chart tracks Zepto's financial trajectory. Revenue jumped from roughly 4,400 crore rupees in 2024 to over 22,600 crore in 2026, while the platform now processes more than 2.3 million orders every single day. The engine driving this scale is a rigid logistical promise, delivering practically anything a customer wants within 10 minutes. By embedding infrastructure directly into residential blocks, Zepto effectively inverted the geographical requirements and logistical physics of Indian retail. But beneath that massive revenue is a stark reality. For 22,000 crore rupees last year, it also recorded a loss of 5,905 crore. The company's operating cash flow remains deep in the red. Maintaining this speed requires unyielding capital expenditure on physical warehousing, marketing, and continuous expansion into new cities. To sustain this cash burn, Zepto is preparing an IPO designed to inject over 8,000 crore rupees into the operation. The absence of positive earnings or free cash flow removes traditional valuation anchors, leaving investors to price the business based entirely on its theoretical future. Evaluating this offering requires setting aside standard profit metrics. The market has to decide whether burning thousands of crores a year is a structural flaw or a necessary weapon to capture market share. The primary mechanism Zepto uses to improve these margins is order density. As a single dark store processes more deliveries in a tight radius, the fixed costs of rent and infrastructure are spread across more transactions. This chart illustrates that effect. As total order volume expanded over the last year, Zepto's operating loss per order dropped from 136 rupees down to 79 rupees. Over that same period, gross margins expanded from 12.8% to 18.6%. These shifting metrics indicate that the underlying math is beginning to work. Each delivery the company completes is incrementally more viable than the last. If the company can maintain that trajectory, the billions spent over the last 3 years may simply be viewed as the necessary toll for building a dominant logistics network. But improving logistics is only part of the equation. The business model is increasingly relying on monetizing the constant attention of millions of digital users through advertising. This graph highlights a 33 times explosion in Zepto's advertising revenue. By working with thousands of brand partners who pay for better visibility, ad revenue surged to over 1,600 crore rupees by 2026. Zooming out, this is happening as quick commerce has become India's fastest-growing consumer internet category, reaching an estimated 85 million users. It is already approaching the scale of highly mature digital ecosystems, actively outpacing both standard food delivery and ride-hailing in annual user growth. Zepto's path to profit is becoming synonymous with its role as a high-margin advertising machine, leveraging its captive retail audience to offset the costs of logistics. However, reaching that point requires surviving immense structural burdens. The physical dark store network currently ties the company to more than 2,700 crore rupees in lease liabilities. Furthermore, quick commerce lacks natural barriers to entry. Customers can switch between competing platforms in seconds, creating a highly volatile, frictionless environment. Zepto is fighting for the exact same urban neighborhoods as deep-pocketed tech giants like Blinkit, Swiggy, Instamart, Amazon, and even Flipkart. If any one of those competitors decides to increase incentives or slash prices, it can instantly vaporize Zepto's fragile, hard-won unit economics. In a market with zero switching costs, sustainable profitability can remain perpetually out of reach every time a rival decides to burn more capital to win a neighborhood. This chart compares how Zepto plans to use its IPO capital. While 1,629 crore rupees is earmarked for opening new dark stores, an even larger amount, 1,735 crore, is required simply to pay the lease rentals on existing operations. The numbers expose a model so fiercely capital-intensive that it must turn to public markets just to fund the infrastructure it is already using today. Add to this the offer for sale component, where several highly informed early investors are actively choosing to cash out portions of their shares precisely as the company goes public. The market is left with a strict binary outcome. The massive momentum of scale and digital advertising will either forge a retail monopoly, or the entire operation will collapse under its own leases. Ultimately, the case for Zepto rests on a single tension: whether scaling at breakneck speed creates a lasting retail powerhouse, or if it is simply an expensive way to rent customer loyalty.